Picture this. A college student sits in his dorm room, staring at a trading account with just $27,000. His parents are going through a messy separation. Tuition bills are piling up, the pressure is suffocating. But instead of cracking under the weight, he makes a decision that will change everything. 6 months later, that same student has turned those $27,000 into nearly a million. Fast forward a decade, and Stephen Dux has become one of the most verified profitable traders in retail history, with documented eight-figure returns that have left even seasoned professionals speechless. But here's what nobody talks about: the psychological warfare that happens inside a trader's mind when money starts flowing in amounts most people can't even comprehend. The mental traps that destroy 92% of traders. The exact moment when a $20 million month nearly ended his career. Today, we're diving deep into the mind of a trader who didn't just beat the odds, he rewrote them entirely. This isn't another success story about getting rich quick. This is a masterclass in trading psychology, risk management, and the brutal self-awareness required to survive in markets that eat dreams for breakfast. Chapter 1. The Genesis of a Trading Mind. Stephen Dux's origin story begins not with privilege or insider knowledge, but with desperation. When his parents' marriage crumbled during his college years, the financial pressure created an urgency that most aspiring traders never experience. This wasn't a hobby or side hustle. This was survival. But here's where most people get the story wrong. They focus on the 6-month timeline, the rapid learning curve, the almost supernatural ability to decode market patterns. What they miss is the psychological foundation that made it all possible. Dux approached trading like an engineer approaches a complex problem. He didn't start by copying someone else's strategy or following YouTube gurus. Instead, he spent 10 hours a day studying human psychology in the markets. Not technical indicators, not chart patterns, human behavior. This distinction is crucial because it reveals the first major psychological insight. Successful trading isn't about predicting market movements, it's about understanding human nature at scale. When Dux analyzed losing trades on verification platforms, he wasn't looking at what went right. He was dissecting what went wrong in the trader's mind. Think about that approach for a moment. While everyone else was celebrating wins and posting profits, Dux was in the digital trenches, studying failure with the intensity of a forensic psychologist. He would pull up losing trades, examine the entry and exit points, and then try to reconstruct the emotional journey that led to disaster. This reverse engineering of failure became the foundation of his edge. Because here's what he understood that others didn't. Every trade is ultimately a bet on human psychology. The market isn't just numbers on a screen, it's the collective emotions of millions of people, all making decisions based on fear, greed, hope, and desperation. Chapter 2. The Psychology of Human Nature. Trading. Dux's approach to strategy development reveals a profound understanding of market psychology that most traders never achieve. His strategies weren't built on technical analysis alone, they were constructed around predictable human emotional responses. Consider his core methodology: identifying stocks that have dropped significantly, leaving holders frustrated and desperate. When these same stocks gap up toward their original prices months later, what happens? The trapped holders, finally seeing a chance to get even, rush to sell at the open. It's not a technical pattern, it's pure human psychology playing out in real time. This insight led to one of his most powerful realizations. The market rewards those who can think like the majority, while acting like the minority. When frustrated holders are selling in panic, Dux is positioning himself on the short side, knowing that emotional selling creates predictable price movements. But implementing this strategy required more than just understanding psychology. It required developing systems to counter his own psychological biases. This is where the story gets fascinating, because Dux had to become a master of self-manipulation. Take his profit withdrawal strategy. Every time he made a significant gain, he would immediately withdraw 80% of the profits and tell himself it was actually a loss. This psychological trick served multiple purposes. It prevented him from becoming overleveraged on the next trade. It protected his capital from his own greed. And most importantly, it kept him humble and focused. The genius of this approach becomes clear when you consider what happens to most traders after a big win. They feel invincible. They increase their position sizes. They take bigger risks. And inevitably, they give it all back. Dux short-circuited this psychological trap by reframing wins as losses in his mind. This level of psychological sophistication separates professional traders from gamblers. It's not enough to have a good strategy. You need systems to protect yourself from your own human nature. Chapter 3. The Data-Driven Approach to Market Psychology. While most traders rely on intuition or incomplete information, Dux built his edge on comprehensive data analysis. But this wasn't just any data. It was psychological data disguised as market statistics. His process for developing strategies reveals the intersection of psychology and quantitative analysis. He would identify behavioral patterns, like the frustrated holder scenario, and then backtest them across different market conditions, timeframes, and stock characteristics. For example, he discovered that his strategies worked best within specific market cap ranges, volume thresholds, and price points. But these weren't arbitrary technical levels. They were psychological boundaries, where human behavior becomes most predictable. The market cap sweet spot of $10 million to $100 million represents companies small enough for retail emotion to drive price action, but large enough to avoid complete manipulation. The volume requirements ensure enough participants are involved to create reliable psychological patterns. The price thresholds filter out stocks where small dollar movements don't trigger emotional responses. This data-driven approach to psychology gave Dux something most traders lack: confidence in his edge. When you understand not just what works, but why it works, you can execute with conviction even during drawdowns. But here's where the psychological challenge becomes acute. Maintaining this analytical discipline while managing significant capital requires extraordinary mental fortitude. As account sizes grow, the temptation to deviate from proven methods intensifies. The dollars involved can overwhelm even the most disciplined psychological frameworks. Dux solved this by creating what he calls his perfect trader calculator, a theoretical model of flawless execution based on his statistical analysis. By comparing his actual performance to this idealized version, he could measure success based on execution quality rather than monetary outcomes. This psychological reframe is crucial. Instead of being driven by P and L emotions, he focused on process adherence. This allowed him to maintain consistency even as trade sizes grew from thousands to millions of dollars. Chapter 4. The $20 million month that almost destroyed everything. Success in trading creates its own psychological demons, and Dux learned this lesson in the most painful way possible. In 2021, he achieved something that most traders can only dream of: a $20 million month. The money was intoxicating. The recognition was overwhelming, and it nearly cost him everything. The psychological trap of extreme success is subtle but deadly. When everyone around you is calling you the best trader in the world, when the numbers seem to validate your every move, when money flows in amounts that feel surreal, your ego begins to rewrite reality. Dux describes this period with brutal honesty. My ego was going way over my head. He bought 2 Koenigsegg supercars worth hundreds of thousands each. He started believing his own hype. And then the market reminded him of a fundamental truth: ego is the enemy of consistent performance. The next month, he lost $800,000 on what he describes as the stupidest ticker. Another $400,000 disappeared the month after that. These weren't calculated risks within his system. They were emotional trades driven by overconfidence and inflated self-perception. This experience illustrates one of the most dangerous psychological phases in a trader's development: the transition from hungry student to overconfident master. The very success that validates your approach can become the catalyst for your destruction. But here's what separates exceptional traders from cautionary tales: the ability to learn from psychological failure and build systems to prevent it from recurring. Dux's response to this crisis reveals the depth of his psychological sophistication. He created his perfect trader comparison system specifically to combat ego inflation. Every month, he measures his performance against a theoretical ideal based on his statistical models. When he tells himself he's only performing at 25 to 30% of his potential, he's not being self-deprecating. He's using cognitive psychology to maintain humility and hunger. This internal narrative serves as psychological armor against the success that destroys most traders. By constantly focusing on improvement rather than achievement, by measuring process over profit, he built immunity to the ego trap that claims so many careers. Chapter 5. The Art of Risk Psychology. Managing risk isn't just about position sizing or stop losses. It's about managing the psychological relationship with uncertainty and loss. Dux's approach to risk management reveals sophisticated understanding of behavioral psychology applied to trading. His sizing methodology demonstrates this perfectly. When he makes a mistake, he immediately cuts his next position size by 50%. This isn't just capital preservation, it's psychological conditioning. By linking errors to immediate consequences, he creates a feedback loop that reinforces careful decision-making. But the psychology goes deeper. Dux understands that emotional states compound. A trader who's frustrated from a recent loss is more likely to make impulsive decisions. By reducing size after mistakes, he gives himself permission to rebuild confidence gradually rather than trying to recover immediately. The inverse relationship is equally important. When trades go his way, when his analysis proves correct, he's willing to amplify his risk using profits as additional capital. This dynamic risk management reflects deep psychological insight. Confidence earned through successful execution should be leveraged, while confidence damaged by errors should be rebuilt slowly. This approach contrasts sharply with how most traders handle risk. They often do the opposite, increasing size after losses to get even, and reducing size after wins to preserve gains. This backward psychology explains why most traders struggle with consistency. Dux's risk management also extends to his relationship with money itself. By withdrawing profits immediately and reframing them as losses, he prevents capital from becoming an emotional anchor. Money in the account isn't his until it's withdrawn, a psychological distance that prevents over-attachment to unrealized gains. The sophistication of this approach becomes clear when you consider the alternative. Traders who become emotionally attached to their account balances often struggle with decision-making as numbers grow larger. Every trade becomes about preserving wealth rather than executing strategy. Chapter 6. Pattern Recognition and Market Psychology. Professional trading requires the ability to recognize patterns not just in price action, but in collective human behavior. Dux's edge comes from understanding how crowds of traders react to specific market conditions, then positioning himself to profit from these predictable responses. His concept of dollar blocks illustrates this psychological insight. He tracks how much retail money flows into momentum stocks, recognizing that there's a limit to how much individual investors can collectively bid up a stock before institutional selling overwhelms their buying pressure. This isn't technical analysis, it's crowd psychology quantified. When a stock reaches a certain market cap relative to retail participation, the mathematics of supply and demand shift. Knowing this inflection point allows him to position for the inevitable reversal. The psychological beauty of this approach lies in its foundation on human limitations rather than human emotions. While emotions are unpredictable, the financial capacity of retail traders is measurable. When that capacity is exhausted, price movement becomes predictable regardless of sentiment. But recognizing these patterns requires psychological discipline that most traders lack. It means taking positions against momentum when everything feels bullish. It means shorting stocks that have made people wealthy while they're still celebrating. It requires the mental fortitude to bet against the crowd when the crowd is winning. This contrarian psychology is perhaps the most challenging aspect of professional trading. It goes against every social instinct humans have developed. We're wired to follow the herd, to seek safety in numbers, to avoid standing alone. Successful trading often requires doing exactly the opposite. Dux's ability to maintain this contrarian mindset comes from his data-driven approach to psychology. When you have statistical evidence that certain behavioral patterns lead to predictable outcomes, it becomes easier to act against your social instincts. Chapter 7: The Mathematics of Emotional Control. One of the most revealing aspects of Dux's psychology is how he uses mathematics to control emotions. His approach transforms subjective feelings into objective measurements, creating psychological distance from the emotional intensity of trading. Consider his monthly trade review process. Rather than focusing on how much money he made or lost, he analyzes whether each trade fit his statistical criteria. Profitable trades that deviated from his system are treated as future losses, money he'll inevitably give back because it wasn't earned through process adherence. This mathematical framework for emotional evaluation serves multiple psychological purposes. It prevents him from becoming overconfident after lucky wins. It maintains focus on process over outcome, and it creates a feedback loop that reinforces systematic thinking over emotional decision-making. The sophistication of this approach becomes clear when you consider the alternative. Most traders evaluate performance based on P and L alone. If they made money, they feel good. If they lost money, they feel bad. This emotional relationship with outcomes creates a psychological roller coaster that eventually destroys decision-making ability. By divorcing emotional evaluation from monetary outcomes, Dux maintains psychological stability regardless of short-term results. This stability is crucial for long-term success because it allows consistent execution even during inevitable drawdown periods. The mathematical approach extends to his expectation management. Rather than hoping for specific dollar amounts, he calculates theoretical maximum performance based on market conditions and his strategic edge. This creates realistic benchmarks that prevent both overconfidence and disappointment. When he says he performs at only 25 to 30% of his theoretical potential, he's not being modest. He's using quantified psychology to maintain hunger and prevent complacency. This internal measurement system keeps him focused on improvement rather than achievement, process rather than profit. Chapter 8: The Loneliness of Excellence. Trading at the highest levels creates a psychological isolation that few people understand. When your daily decisions involve millions of dollars, when your monthly income exceeds most people's lifetime earnings, when your understanding of markets surpasses that of seasoned professionals, you enter a realm where very few can relate to your experience. Dux's description of his daily routine reveals this isolation. He wakes up before dawn, analyzes markets alone, makes split-second decisions with massive financial consequences, then returns to a world where most people worry about expenses he considers trivial. The psychological weight of this disconnect is immense. This isolation is compounded by the nature of trading success. Unlike other professions where achievement is recognized and celebrated socially, trading success often breeds skepticism, envy, or disbelief. The need to prove legitimacy through verified results adds another layer of psychological pressure. The mental health implications are significant. Depression, anxiety, and social disconnection are common among high-performing traders, not because they're failing, but because they're succeeding in a way that separates them from normal human experience. Dux addresses this challenge through deliberate psychological practices. He maintains friendships with other high-level traders who understand his reality. He engages in activities completely unrelated to trading, video games, sports, music, that provide mental escape from the intensity of market analysis. Perhaps most importantly, he maintains humility about his achievements. When he describes himself as probably the worst trader compared to his theoretical potential, he's not displaying false modesty. He's using psychological techniques to maintain connection to the learning mindset that created his success. This humility serves as protection against the ego inflation that destroys many successful traders. By focusing on improvement rather than achievement, by measuring process rather than profit, He maintains the hungry student mentality that drives continuous growth. Chapter 9: The Cost of Mastery. Professional trading demands sacrifices that extend far beyond financial risk. The psychological cost of maintaining edge in competitive markets is enormous, requiring levels of focus, discipline, and self-awareness that most people cannot sustain. Dux's description of cutting computer mice to prevent overtrading reveals the extreme measures required for psychological control. This isn't quirky behavior, it's recognition that in high-stakes environments, even small lapses in discipline can have massive consequences. The mental energy required for consistent execution at this level is exhausting. Every trade requires complete focus. Every market movement demands analysis. Every profit or loss needs psychological processing to prevent it from affecting future decisions. The cognitive load is immense. This intensity creates a psychological paradox. The skills that enable trading success can make normal life feel mundane and unfulfilling. The adrenaline of million-dollar decisions makes everyday experiences seem flat by comparison. Many successful traders struggle with this emotional contrast. The solution, Dux suggests, lies in finding purpose beyond profit. His competitive drive comes not from money, but from the challenge itself, the intellectual satisfaction of solving complex problems, the personal growth that comes from mastering difficult skills, the continuous learning required to maintain edge. This shift in motivation from external rewards to internal satisfaction is crucial for long-term success. Money alone cannot sustain the psychological demands of professional trading. There must be deeper sources of fulfillment: intellectual curiosity, competitive spirit, personal development. The traders who last, who continue performing at high levels for decades, are those who find meaning in the process itself rather than just the outcomes. They become students of human psychology, market mechanics, and their own behavioral patterns. Chapter 10: Lessons for the Aspiring Trader. Dux's journey offers profound insights for anyone seeking trading success, but the lessons extend far beyond market technique. They reveal principles of psychological development that apply to any challenging endeavor. First, sustainable success requires systems to counter human nature rather than relying on willpower alone. The most disciplined person will eventually make emotional decisions under pressure. The key is building frameworks that guide behavior, even when emotions are running high. Second, edge comes from understanding psychology rather than just market mechanics. Whether you're trading stocks, negotiating deals, or managing people, success depends on accurately predicting human behavior under specific conditions. Third, growth requires embracing failure as a learning opportunity rather than a personal judgment. Dux's practice of studying losing trades reveals a mindset that treats setbacks as data rather than defeat. This psychological reframe accelerates learning and builds resilience. Fourth, true expertise demands constant measurement against idealized performance rather than comparison to others. The perfect trader calculator concept applies to any field. Success comes from competing against your potential rather than your peers. Finally, sustainable excellence requires finding meaning in process rather than outcomes. The traders who last are those who love the game itself, not just the rewards it provides. This intrinsic motivation sustains effort through inevitable difficult periods. These lessons remind us that trading, like all demanding pursuits, is ultimately a journey of self-development. The markets serve as a mirror, reflecting our psychological strengths and weaknesses with brutal honesty. Success requires not just technical skill, but the emotional intelligence to understand and manage our own human nature. Stephen Dux's story isn't just about turning thousands into millions. It's about the psychological transformation required to achieve excellence in any field that demands consistent performance under pressure. The real edge isn't in the strategies he uses, but in the mindset that created them. For those willing to undertake this journey, the rewards extend far beyond financial gain. The skills developed in trading pattern recognition, risk management, emotional control, continuous learning, create value in every aspect of life. But they come at a cost that must be honestly considered before beginning. The choice, as always, is yours. But now you know what you're choosing between: the comfort of mediocrity or the demanding path toward mastery. Choose wisely and remember, the markets don't care about your hopes or fears. They only reward those who understand themselves well enough to act rationally when it matters most.